Hello and welcome to the 10th of our CIMA F3 Financial Strategy Lecture recaps. This one was on working capital. Okay, so the components of working capital first of all. Well, you'll generally have to fund basically your net current assets. So your current assets will be your cash, your inventory and your receivables, less your current liabilities, which will be your overdraft and your payables. So when we're thinking of the components of working capital, these are it. So our syllabus talks a little bit about overtrading, but what is overtrading? Well, overtrading is simply a lack of cash or a lack of liquidity to support the business, i.e. the business is trading well, but it has a lack of cash and is illiquid, isn't able to fund its working capital. So signs of this, well, if there's rapid expansion of the business, or if there is a deteriorating, first of all, current ratio, which is our current assets over our current liabilities, or a deteriorating quick ratio, current assets less inventory over current liabilities. Remember that we subtract the inventory because it's illiquid, so we want to get a better quick ratio. The working capital cycle then is made up of our inventory period plus our collection period less our payables period, and that gives us the length of our working capital cycle. The elements of that are calculated as being our inventory period, which is our average or current inventory over our cost of sales, times 365. Remember, we can restructure that calculation to work out our average or current inventory by being the cost of sales divided by 365 multiplied by the number of days if you're given in a question. So remember, you can move this formula around to work out different parts of the cycle. So the inventory period is that. The collection period is our average current receivables over our credit sales. Remember, just be careful in a question that it's the credit sales. If we have cash sales, they are paid to us immediately, and that's times 365 again. And then our payables period is our average or current payables over our credit purchases, times 365, again being careful that if there are cash purchases, they're paid straight away, so won't form part of our payables period. And we did a little example of that in class. That brought us on then to our working capital financing. So we had to differentiate between our different types of assets. Remember that we have our permanent current assets. These are required day to day to support the day-to-day trading of the company. We have our fluctuating current assets depending on short-term or seasonal effects. You may need more current assets or less current assets in the short term, so they'll fluctuate. That's over and above the permanent current assets. And lastly, of course, we've got our fixed assets. So we'll have our fixed assets, we'll have our permanent current assets, and then we'll have our fluctuating current assets. And the fluctuating ones aren't needed all the time and fluctuate depending on the seasonal or short-term effects. Remember, we talked about the matching principle, which is that we match our short-term assets with short-term finance, and likewise then we finance our long-term assets with long-term finance. That's really quite a traditional view of how you would approach capital financing. The modern approach, well, some permanent current assets will be funded with long-term finance. It's prudent to do so. Okay, we use our long-term finance because those permanent current assets are needed all of the time. So on a prudent basis, we fund them with long-term finance. Fluctuating current assets, well, these are generally funded with short-term finance. So we have a choice when we're funding our current assets. We have a choice between, first of all, taking an aggressive approach. An aggressive approach would mean that we will fund very little of our permanent current assets out of long-term finance. We'll rely on short-term finance to cover our fluctuating current assets and a lot of our permanent current assets as well. The benefits of doing this, we'll have lower financing costs because we're not financing out of long-term finance. Our profitability should therefore be increased, and it will fund expansion. We'll have more liquid assets available to fund expansion. Conservative approach, well, the benefits of it are there's less liquidity risk. We meet sales demand changes more easily because we have more liquid assets. And giving credit should equal more sales. I.e., if we give more credit to our customers and have a more conservative approach, then that should equal more sales for us. Remember that we could just take a moderate approach, which is somewhere in between those two and strikes a balance between them. And that was our lecture on working capital